Welcome to this explainer. Okay, so you've got an old IRA and you're thinking about moving it to a new bank, right? But you're probably terrified of making a mistake that's going to cost you a fortune in taxes. I totally get it. Today, we're diving into exactly how you can safely migrate your hard-earned retirement savings without triggering a single IRS penalty.
Seriously, are you afraid of the IRS taxing your retirement move? Because if you are, that fear is completely valid. Making one little structural mistake when moving an IRA can accidentally trigger a massive tax bill. It's incredibly common to trip over these complex tax rules, and nobody wants to hand over a chunk of their nest egg to penalties. So let's figure out how to avoid those traps.
Okay, let's dive right into this. Here's our roadmap for today. First, why move your IRA? Second, transfer versus rollover. Third, research and gather documents. Fourth, initiating the transfer. Fifth, completion and account management. And finally, an important financial disclaimer.
All right, Section 1. Why move your IRA? Consolidating for better growth.
Before we get into the actual mechanics of the move, let's talk about the why. Moving your IRA isn't just about escaping those annoying high maintenance and transaction fees at your current bank, though, let's be real, stopping those fees from eating your savings is a huge plus. By moving your money, you can actually optimize your growth potential by getting access to better, lower-cost investment options. Plus, you can simplify your whole financial life by rolling multiple old accounts into one centralized spot. And hey, moving to a new place might even mean you get to work directly with a personalized financial advisor who really gets your specific goals.
Moving right along to Section 2, transfer versus rollover, the safe way versus the risky way.
Now, you might be wondering, what's the big deal? Well, this is literally the single most critical concept in our entire explainer. There is a massive contrast between your two options here. A trustee-to-trustee transfer, that's the safe way. It is a completely non-taxable event where the money is routed directly between the banks. You never actually touch the cash, which means you can do this as many times as you want. An indirect rollover, on the other hand, is the risky way. You run a really high risk of triggering a taxable event because the bank makes the check out directly to you. Suddenly, you're on a super strict 60-day deadline to redeposit it, and the IRS only lets you do this once a year.
Let's look a bit closer at that 60-day rule. It's exactly what it sounds like, a strict IRS deadline requiring you to redeposit those indirect rollover funds into a qualifying account. If you miss this incredibly tight window, the IRS basically says, yep, that's a distribution. And boom, you're hit with massive income taxes on the whole amount. Oh, and if you're under 59.5, add a 10% early withdrawal penalty on top of that. Missing this unforgiving deadline can absolutely devastate your retirement savings.
And then, there's the one rollover per year rule. The IRS says you can only do one 60-day indirect rollover across all your IRAs within a rolling 12-month period. It's absolutely crucial to remember that this applies to all your IRAs added together, not just one specific account. If you cross this limit, even by accident, any other rollovers you try to do are considered ineligible. That triggers excess contribution taxes and penalties that will just chew right through your hard-earned nest egg.
To put all these complex rules into perspective, let's look at a real-life case study from our sources. Meet Naomi. She had an old IRA sitting at Broker A, and she needed to move $45,000 to a brand new account over at Broker B.
So she does that, right? Well, just 2 months later, Naomi decides she wants to consolidate her finances even more. She successfully moves an additional $30,000 from a totally different account at Broker C straight into that exact same new account at Broker B.
And this brilliantly illustrates the whole point. Naomi completely bypassed that strict IRS one per year limit. How? Because she used direct trustee-to-trustee transfers. If she had used those risky indirect rollovers we talked about, that second move of 30 grand would have triggered some severe IRS penalties, simply because it happened within the exact same 12-month period. But since she requested direct transfers, where the institutions handled the money, she completely avoided the IRS limits, the 60-day clock, and the tax penalties. The whole shebang.
Let's jump to Section 3, research and gather documents, preparing for a smooth move.
All right, now that you know the safest method, let's map out exactly what you need to actually do this. First up, grab your current IRA account number and find out the exact dollar amount that's available to transfer. You're also going to need a recent account statement. Our sources strongly recommend having one that's less than 6 months old. Finally, just give your current custodian a quick call to verify if a medallion signature guarantee is required to release the funds. Having these specific documents ready to go is going to make opening your new account totally seamless.
Okay, Section 4, initiating the transfer, putting your move into motion.
So how do we actually pull the trigger? Here are the actionable steps. Step 1.
open an identical tax type IRA at your new bank. That means if you have a traditional IRA, you open a traditional IRA. Roth goes to Roth. Make sense? Step 2. Submit a transfer request form directly to your new custodian. And Step 3. Just sit back and let the two institutions handle it. The crucial point here is you want your new bank to initiate the pull of the funds. That keeps you safely out of the middle of the transaction.
Moving into Section 5, Completion and Account Management, Crossing the Finish Line.
Now, managing your expectations while you wait is key. A standard digital trustee-to-trustee transfer that usually takes about 5 to 7 days to complete. But if your old bank is a little old school and requires a manual paper-based transfer, expect it to take closer to 7 to 10 days. And, just as a friendly reminder of the immense danger we discussed earlier, 60 days is that strict, unforgiving deadline if you accidentally chose an indirect rollover and ended up with a check in your hand.
Once your funds finally arrive safely at your new bank, please take action. Don't forget to invest. You'd be surprised how common it is for people to do all this hard work to move an IRA, only to just leave the money sitting there in cash, earning basically nothing. Pick your assets, choose investments that match your risk tolerance, and make sure that portfolio keeps growing and working hard for your future.
Finally, Section 6, Important Financial Disclaimer. Protect your nest egg.
As our sources clearly state across the board, consult with a professional tax or financial advisor before making any decisions regarding your retirement assets to avoid tax penalties. Listen, everyone's tax situation is totally unique. While this explainer gives you the clear structural mechanics of how these transfers work, it is always a fantastic idea to run your specific situation by a pro to make sure your personal goals are covered.
Which brings us to our final thought. Is your current bank really the best home for your future? You now have the knowledge and the roadmap to safely navigate the migration of your retirement savings. You know how to bypass the risks, skip those indirect rollovers, and use a direct trustee-to-trustee transfer to take confident control of your wealth. Thanks so much for hanging out with me for this explainer, and here's to optimizing your financial future.